Hey everybody, Marty Mazur. Good afternoon, March 10th, 2016. I'm going to talk at you just for a minute about the happenings of today and then finish up with the charts. I'll try to keep it quick, although it was quite the day today. We started early this morning with the European Central Bank moving its deposit rate further into negative territory and increasing its quantitative easing program, which would be the monthly buying of securities program in an effort to push more banks into the Eurozone economic system, if you will. Immediately, the euro dropped against the U.S. dollar, and U.S. stocks rallied hard. Dow futures were up before the open like 150 points. But then oil began to come down, and ironically, the euro rallied pretty hard against the dollar, and the experts tell us that that was on Draghi's comments, Mario Draghi, the European Central Bank president, that he thought he wouldn't need to go any lower on rates. And you might translate that to markets just have no tolerance for any central bank hesitation, and that seems to be the consensus view today. Um, I'm not completely in that camp. I guess I'm in the very much the minority camp. I actually see that there's the potential for the Eurozone economy to surprisingly outperform this year. This week we saw French and German industrial production, for example. Those numbers were at multi-year highs. And while many very smart people would tell you that at the end of the day, it's the interest rate differential that counts when it comes to currencies, and that is the currency of the country with the higher interest rate will always be the stronger currency. History, as I charted for you mid-year last year, does not support that notion, not nearly all the time. In fact, you could argue that money will flow to the best economy, and that's where the economy or where the currency will be stronger. So, as we've noticed up until some point last year, the dollar had staged a phenomenal rally to the upside as the U.S. economy was outperforming most other economies. Now, perhaps, despite the issues that we all know about in Europe, perhaps the Eurozone economy is poised to do better, and maybe the currency markets and currency traders see that as a potential. You never know for sure, but I think that's a very plausible explanation as to why the euro has not fallen apart under the weight of some very stimulative monetary easing measures from the European Central Bank. But today was one of those weird days. Oil and stocks at times traded together, at times they didn't. We closed the day, the Dow having at one point tanked. It was down about close to 200 points, I think. Came back and closed essentially even while oil was down over 1%. That's not the relationship we've grown accustomed to of late. But again, there were times during the day when they did seem to move in tandem. Bond yields rose. We're getting closer to 2% on the 10-year Treasury. That's actually potentially a bullish sign for the economy. That would say something bullish, although 1.93 is historically very low on the 10-year. In terms of sectors, the breadth of the market was fairly evenly divided. No real outstanders or outstanding sectors. Materials did pretty well, relatively speaking. The one Eurozone fund that ETF was up a third of a point, so it had outperformed the U.S., but emerging markets were pretty flat. So after a very volatile day, at the end, we closed pretty much where we began, and the pundits are having just a devil of a time explaining what really went on today. And so, folks, when you can't explain it based on what goes on in the real world, then you resort to the charts and you think, well, maybe in the absence of clear catalysts for market moves, maybe it's the technicals. Now, I've been showing you the last couple of days. This is the S&P 500, the 60-day, 60-minute chart, this upward sloping wedge pattern, and telling you that technically is bearish, and that there was a good chance that we break out below that, and we've seen that happen. And we started having that discussion right about here, and here we are currently. Oftentimes what was once support becomes resistance, and that kind of looks like what happened today. We came down and tested quite hard, actually, this 62% retracement. I think passed the test, came down below it, but then couldn't basically hold it, and then came bouncing higher. So it looks to me like technicians were really moving this market around, and that explains a lot of the volatility. I at some point I'm going to have to draw another trend line, and maybe that's the next support level. So it'll be interesting to see as we fan these out. If we break through this one and we draw a third one somewhere down further, then technically that tends to be something bearish if we penetrate that. But this was a little too steep anyway, so this maybe makes some more sense. So folks, from a pure technical trading standpoint, I could make a case. There's a lot of indicators I'm not showing you here that have to do with moving averages and other things, but I can make a case in either direction at this point. And looking at further back at the 1-year chart and going back to the all-time high last May 21st and retracing that level, maybe we get to something more substantial in terms of what's going on. So if I go back here to that high and draw it down to the low, suddenly we see this 50% retracement level, and in these two areas, the 62 being very important perhaps, and you can see that we got right up to that 2010 mark. I'm hearing a lot of technicians talk about that, and then bouncing off of this 1972. So we're finding that maybe there's a lot of money trading on the retracements that take us back to the all-time high and trace us down to the low. So we'll see. We'll continue to look at that. Folks, always please keep in mind that what I'm doing here is not actionable for you and me. This is really just me helping you put the short term, which can get pretty noisy, into what I believe to be its proper perspective, and try to explain why what appears to be just craziness at some level inside the market is always going to make sense. But for you and me, we'll continue to own good stuff and own it for the long term. We'll expect to someday come back up and, as I promised, fill these gaps and see the market at all-time highs. But wish I could tell you when, but between now and then, I'll keep you abreast on the world's developments. Thank you, as always, for watching and listening, and I'll talk to you very soon. Take care.